The debate is how hot will inflation run? How high will it go? I think that's a given narrative in the market. Cecilia Roos, the chair of the White House Council of Economic Advisors, says there's no de-anchoring of prices. From what you've seen in inflation, break-evens and real rates, are we moving into a de-anchoring phase?
I think, it's pretty clear that inflation is going to be coming and it's going to be real. As you guys were highlighting early on, Buffett saying that the economy is running on hot, inflation is here. We're basically never going to hear those words from Powell or any kind of Fed chair. So that's just, something to kind of keep in mind. They're always going to be cool, calm, and kind of collective. But I think we're already at the tipping point, and that's only going to accelerate as we, get towards summer in the U.S. and, get towards a lot more kind of maximum vaccination kind of across the board. It's set to kind of actually accelerate over the next kind of few weeks. So definitely cat's out of the bag on that.
It's pretty much a buying frenzy out there, is how Warren Buffett described it. People have money in their pockets and they're using it to pay for goods at higher prices. When you look at U.S. yields, then your 10-year, is that capped then, likely to be capped at around 1.5, and the 20-year might be capped at 2%. Is that what you're looking at with your team, Kay?
We're expecting it to keep on moving up higher. I've been quite wrong in regards to this stabilization period. I would have been expecting us to break out higher. But, I think you have to remember, we were at 90 basis points, right, just literally a few months ago. And now we're sitting here at these kind of 1.58 to 1.77 range. The key thing that everyone's really watching for is what's the next big catalyst from the Fed. We know the June 16th meeting is definitely one that I'm watching, but that, everyone else it's a kind of known unknown. Will we see the upgrade on their forecast, both from a growth GDP as well as inflation perspective, or do we have to wait until the September kind of 23rd? But, the thing that is mainly, I think, under the Fed watch is employment. So the jobs data. So the bigger the tick that we have in the jobs data, the more, I guess, you can see a follow-through on inflation and on yields, more importantly. But the tricky part, as we all know, is the capital gains tax. It's definitely not a dovish win for the Fed, right? So it's something that also complicates the matter in regards to how soon they could be acting.
Well, we're going to get another jobs report this week, and I think that this is the point Bloomberg Economics say is that the taper is hanging by what they call a string. We know Powell wants to see a string of employment prints, probably in excess of 1 million. So where does that possibly put the taper discussion? Kaplan says it should be now. How many strings of 1 million do you think we need to see before a true taper conversation takes place?
This is a phenomenal question, and I don't know. I would even like to justify that with another question. Can they really taper when we still don't know how much more spending is going to be coming, right? I think that's also something that a lot of people have just not thought about. It looks like this administration is just getting started. So I really, really, really don't know. But one thing that I think the Fed is really watching firmly, and Powell has said it again and again, and he is getting more constructive about it, is on jobs coming back. And, if you go back and you look at early 2020, we went from 3.5% unemployment rate, then to 4.4 for March, and then we jumped to 14.7, right? So it was not linear. It was exponential. And also a big part of the employment industry in the U.S. is food and beverage at close to over 10 million. So I think we're going to get the same thing. I think it's going to be linear, and then it's going to be a big leap in regards to the jobs kind of coming back. But just one last kind of caveat on this that, again, complicates the matter is, incentives, they still run until September, right? So, people can still sit on, the payouts and really don't have to get off the couch until September. So there are also some structural issues here.
In terms of the outlook, Kay, and your conviction calls, this world reopening theme, is that taking a bit of a tactical breather in line with an improvement in the misery index? Could that be set for a re-rating then at the back end of the year? What are you telling clients?
Yeah, I think massively so. We've been banging the drums on that even all the way back end of last year when it was, super unsexy. But I think it's going to be harder than anyone could expect. Because if you think about it, if you're used to traveling, you're sure as hell going to travel. And even if you didn't travel before, well, guess what? You're tired of your four walls and, your normal kind of town, right? And a lot of the supply has kind of gone away also in that hospitality sector. There's even less competition. So it's just going to, I think, go smoking hot. And I'd expect the U.S. domestic travel scene to continue to explode upwards. So things like Airbnb, the hotels, Expedia, the travel names, airlines, should do very, very well over that kind of next 6 to potentially even 18 months. And you're going to see this lag effect just ripple regionally across the globe as well.
Okay, I look at the most read story, or at least one of the most read stories on the terminal in the last hour, and it is development from Huarong, the distressed debt manager, and in many ways the company executive coming out and trying to reassure investors, saying they will repay their bonds, that they still have state backing. How critical is it that the government, together with Huarong, finds a resolution to this process to keep credibility intact?
I have a bit of a macro picture here. When I first got to Asia in 2010, all you kept hearing was, China credit, it's not real, they don't default. And now we're starting to get defaults and people are complaining like all over again, right? So it's kind of like, no one's kind of happy one way or another. I think what we're going through in China has to be seen from just a development, big picture perspective, right? Of allowing businesses, to fail and taking away that, kind of underlying kind of put for everyone kind of involved. I'm not on top of the actual, name and the repercussions kind of one way or another. But to me, it just seems unnatural that this is the way. Like you have to let eventually the market be able to kind of price itself. And that also will allow that market to also extend not just from the big names, but also into the SME space that really needs that financing and funding, right?
Yeah, you're right, Kay. You can't please all of the people all of the time. But let's try and please some of the people that want a return on equity. Your macro dragon call is that China is your North Star. Is it still your resplendent North Star? And how do I take my position to China? Is it you are doubtful through the FX prism, so do I lean more into the equity prism?
Yeah, I would think so. And, that North Star just kind of came out of the fact that, they were the first into the crisis, obviously, last year. They were the first out. And you actually now seeing that lag effect with now it's the U.S. is basically their time kind of in the sunlight. And then after that, it's going to be UK and then Europe as a whole. So I think on China, yeah, if I had to choose an asset class, it would probably be kind of equities. And it may even actually be kind of tech and what's going to be happening there, because that's also a space that's come under a lot of significant pressure, with recent kind of family offices being squeezed kind of out. But that'll be my pathway. I don't think there's too much juice left in the renminbi, especially as we seem potentially to have stopped selling off in the dollar.